Welcome to the Tricord Advisors podcast. This is where we answer your questions to help you get excited about your finances. This is Randy Barkley, and I'm Jeremiah Lee. We're both certified financial planners, and I'm also a California licensed attorney.
Okay, government at work, Jeremiah.
They're doing stuff.
Oh my goodness,
They're doing stuff.
they just passed. They passed what 3 years ago, the Secure Act.
Yeah,
and it changed dramatically. I mean, one of the most significant things they did was the distribution to non-spouse beneficiaries.
Yeah.
But in Secure Act 2.0,
2.0, that's where we're at. 2.0,
4,000 pages. All right. I mean, this is crazy. And we're just looking through the executive summary and trying to provide to our listening audience some of the issues that are coming about. So, I mean, I think we have to top it off with there's a change in the required minimum distribution.
Yeah, there's changing a lot. I mean, we're just going to talk about today some of the key changes. We're not going to talk about everything, but some of the key changes that the Secure 2.0 Act that just came out recently this last year that changes for folks. And a big one is the RMDs. So required minimum distributions. If anyone's over a certain age, you have to start taking money out of your retirement accounts. That's kind of the way the law is written.
You know, it went from 70 and a half to 72. And it's going to
first 73 and then 75.
Okay. So wait a minute. So I can wait until I'm 75 now?
Some people, I can.
I can.
Yeah, you can. I can. So I think it's 1960. Anyone born after 1960, their RMD age is now 75. So meaning for someone like me, I was born after 1960.
I wasn't, by the way, for the listening audience. I was born before 1960.
Yeah. So for me, as I'm getting older, if I retire, I don't have to start taking money out of my retirement until 75. Now, for some people, you have to take it much earlier than that because you need it to retire and to live off of. For others, if they don't need the income, they like to keep it in that tax-deferred environment kind of as long as possible.
Right.
And so now you can go longer. Another idea on RMDs, we're going to talk a little bit about these because there's a few changes. One that people always struggle with is that the IRS doesn't actively track these on a regular basis. However, there's a 50% penalty if you fail to take it. Right. So if you were to get audited and you were past the RMD age and you'd failed to take your RMDs,
it's a pretty heavy penalty.
Heavy penalty. So say you're supposed to take out $20,000, the penalty itself is $10,000, and that's a huge penalty. So they've changed this a bit, and we were just talking previously. Maybe it means they're going to enforce this more because I don't know anyone. I'm sure there's people who've been enforced.
Hey, we've ran across clients who just out of ignorance have not taken the RMDs, like from a deceased spouse, for example. And so we went and I said we need to start, and we caught up. We started.
Yeah, where were the tax professionals?
But there was no reaction from the IRS. Not to say that they wouldn't or couldn't, but the ones that we've seen that we've run across in our practice, there's been virtually no response from the IRS.
And so what they're changing, rather than just having a hard 50% penalty, it reduces it to a 25% penalty. And if you basically notify them, you assert, hey, I failed to take these, I'm taking them now, it's only a 10% penalty. So it takes this big looming thing if you missed it, and it kind of brings it, into my mind, a more manageable way to be able to do it correctly. And third, I forgot to take it, I'm now taking it. But it also changed the statute of limitations on that was a little confusing. So they've clarified it that it's 3 years after you file your tax return for the year in which you were supposed to have taken it. And so it rather than having to look back into years and years and years, it's okay, the last 3 years, what was I supposed to take? Let's file the appropriate paperwork. And it's a 10% penalty, which is much more reasonable than a 50% penalty.
The other one is the QCDs. Now, the QCDs are the qualified charitable contributions, we call it deductions, but it's you can use your IRA, you can use your required minimum distributions to pay for charitable giving. It helps reduce your taxable income, your adjusted gross income on your front page. You would thought they would have changed that, but they didn't. So it's still left that at 70 and a half.
Yeah.
So, but you're not taking an RMD until 73, potentially even later. Mm-hmm. So they're not coordinated. So you can still use it, but it's not an RMD per se. It's just a distribution at 70 and a half that you could use for charitable giving.
Yeah. And this would be for someone who maybe sees that they want to do charitable giving and they have plenty of funds. They have enough funds in their retirement accounts that they're not concerned about running out. And they want to basically reduce those funds a little bit and giving out of those funds rather than their other savings or pensions. It's interesting that the coordination, I'll just make a comment on that. As we go through the Secure 2.0 Act, it is not that everything takes effect a certain date. They're all over the place.
There's so many different ages and years and timelines. Oh my goodness.
Yeah, we were just recently talking with some people who run some retirement plans that we work with, and they are having a difficult time of kind of sorting through when all these things take effect. So when someone shows up and says, I'm 63 years old, I'd like to do this. they used to have an answer for them, and now it's like, well, hold on a minute, let me check and see if we can, or if we can't, or if we have to.
Yeah, it's going to be a lot of consternation to make sure that you're doing right for the participants,
Yeah.
And I think more importantly, as we read through the summary, this is what I refer to as Rothification, because throughout the Secure Act, it is Roth this, Roth that, Roth. Yeah. I mean, it's just Roth. So what's the advantage of that, and who's going to keep track of all this? It's going to be a real amazing, it's going to be in a mess, basically, is what I'm saying.
Yeah, and it'll be an interesting transition. So for, as people generally know, a Roth IRA is different than a kind of traditional IRA or 401k, in that you pay the taxes now. You pay your taxes, you put the money in, but then it grows, all the interest, all the growth is tax-free. And when the money comes out in your retirement, it's all tax-free. And so part of the Secure 2.0 Act, there's a lot in here that makes a Roth more friendly, I guess I'd say, or easier for people to get money into a Roth.
Well, the first thing is that you don't have to take required minimum distributions from a Roth inside of a retirement account now. In the past, if you had it inside a retirement account, you had to take money out.
Yeah, like you had a Roth 401k that you never rolled over. You just left it as a Roth 401k. It used to be you had to take these RMDs.
Right.
And now they've clarified, which I think is appropriate. It lines it up with a Roth IRA.
Right.
It kind of lines those up so they're both the same. But it's interesting. Someone my age, generally, someone in their 30s and 40s should be thinking about a Roth. Does this make sense for me?
Right, for sure.
Well, what they've changed is kind of almost encourage it a bit more, to say there's a lot of opportunities to put money into these Roth accounts, which we ask the question, why? Why would they be doing this? And one could be taxes, to say we want people in their 30s and 40s not to put money away and delay taxes until they're 70. We want those same people to pay their taxes now, and then we're okay to not worry about it when they're older. And whether that's a good idea or not, I'm not sure. I think there's some good planning for people in their 30s and 40s of using Roths. Whether or not it's for everybody, but you should consider it at least. But
they're making it required now. I mean, as far as the plans have to be able to provide this to their participants, whereas in the past it didn't. And so we've had conversation with our plan administrator, and they're going to have to amend the plan. Mm-hmm. The plans are going to be amended, but even simple accounts, simple IRAs, solo 401ks, they have to have this Roth provision built into it for people that want to make that kind of contribution.
And so that's a good comment. There's probably a lot of folks who are employees who just didn't have a good option.
Right.
I would like to do a Roth. I don't have a good option. With the Secure 2.0 Act, they're changing the rules that they're probably going to have an option. And even one of the options is an employer match. A lot of employers, they'll say, we'll match 3% or 4% of whatever you put in retirement. Well, now those matches can go into a Roth account. The negative to the employee is you still get taxed on it. Right. You don't see the money. However, the benefit is that you could get what your contribution is into a Roth, plus the employee match that you received. The employer match could go into that same Roth.
Yeah, and I mean, our attitude is you use tax advantage when your income tax is higher and you want to build additional capital for retirement monies, particularly for people that don't have a public pension that's going to be coming out to them. But you still want to take advantage of Roth. But to have it exclusive, I think they're leaning towards, again, I call it Rothification. I think they are really pushing for Roth. And it makes me suspicious that they're just trying to create more revenue too for themselves, for the government, because you're going to pay more taxes. Because remember, everything you put into a Roth is after taxes have been paid on it. So it's kind of a sleight of hand to some degree.
Yeah. And the benefit, though, is when you do reach retirement, all that growth over the years that you've had, all that money comes out tax-free. It's great when we have clients that have a mix of both. They have some traditional retirement funds, they have some Roth funds, so you can be strategic. So kind of the next one on the Roth idea is the 529 to Roth. We've been talking about this a fair amount. It's an interesting dynamic.
It really is.
So a lot of people probably know you get a 529 college savings account, and you put money in that for a child or a grandkid. And there's always this little bit in the back of everyone's head says, well, what if they don't go to college? Or what if they don't use all the money? And the answer to that in years past has been, well, you can reassign it to a different grandkid or a different child.
The beneficiary.
Yeah, you could use it yourself. You could reassign it to yourself. Or you just have to break out of the 529 and pay some penalties. And that's not a great answer. Well, what they've done now with this rule is that you can take, and there's all sorts of limitations on here, but a portion of the money that's in a 529, if it's been there for like 15 years, if it's been there for a long
there's a
time,
minimum time. You have to have it in the plan for at least 15 years.
Yeah. Then you would be able to take it, and if it's not used, roll it into a Roth IRA
for that beneficiary.
So think of a grandkid. You set up a Roth, or you set up a 529 for a grandkid, They go to college, they use some of it, but they've got, say, $20,000 left over. If that 529 existed for 15 years, you're then able to start rolling some of that money out into a Roth IRA for that grandkid,
Right.
which a grandchild, and the limit there, of course, is 35,000 total. And even in that, it's chopped up each year. You can only
Right.
do the limit each year. So maybe it takes you 5 years to get all the money over. But to have a grandchild who's 25 to 28 that now has $35,000 in a Roth IRA, that's a good benefit for their retirement.
Correct. And again, I think most contributors, most grandparents, parents that are putting money into 529s, they're probably not thinking there's going to be anything left over. But we've cautioned clients not to over contribute to 529s because of the very reason, like what do you do with excess balances? Or if the child goes to the military or gets a scholarship or something's different, they're not using that money, what do you do with that? So you want to be really careful. This gives you a good option on what to do with those excess funds, if there should be any excess funds, right?
And $35,000, I'm not sure if I like it or not, but that being the limit, it's not. I don't see this turning into an abused plan to say someone's going to pack money into a 529 and then secretly get it to their kid, some kind of wealth transfer scheme.
I think the time frames on it are going to prevent a lot of that. I mean, you 15 years, you have to have it in plan. So most people don't plan 15 years in advance to pack a Roth for their child.
Yeah, but if they were to have an extra 529, I could see people making good use of that. We're gonna come back and talk some more about the Secure 2.0 Act, so stay tuned.